And welcome back to another Econ Podcast with Mr. Hagan. On this Econ Podcast, we're going to continue to talk about investing, but I do want to remind viewers that this video is not designed to give investment advice. Its purpose is educational only. This videos and other videos in this playlist are designed to teach about different theories of investing. If you want investment advice, please see a professional. All right, so we've been talking about on these most recent videos, we've been talking about the random walk theory, sometimes also called the efficient market hypothesis. And we said one of the big focuses of the random walk guys or the efficient market hypothesis guys is to focus on the concept of risk and how to manage risk. And we talked about risk on some previous videos, how to think about risk with regards to return, how to think about risk with regards to stocks and bonds, things like that. We want to get into some more risk on this video, some more concepts of risk. And what we're going to do is we're going to look at the two different types of risk. We're going to look at two different types of risk. The first type of risk that we're going to look at is what is called specific stock risk. Specific stock risk. And this is the risk of putting too much money. We could debate exactly what that means, but too much money into one company. Okay, this is like putting all your eggs in one basket. So if you put all your eggs in one basket, you drop the basket, obviously you're going to lose all your eggs. You want to diversify your eggs into different baskets. So if you drop one, it's not disastrous. Same concept with stocks. If you put all your money into one stock, into one company, and that company, something happens, they get sued, they go bankrupt, they whatever, then you lose all your money. And so the idea is to put your money into a lot of different companies. Okay, so don't take specific stock risk. Instead, you want to eliminate specific stock risk. And let me talk about a very simplistic example of how this would work. So let's imagine that we're going to create a portfolio with two companies, an umbrella company, and a sunscreen company. So let's imagine this. Let's think first of all. Let's think what would happen if I put all of my money into the umbrella company. If I invested all my money in umbrella stocks, and let's say during year one, it's very sunny, it's very nice, and so the umbrella company, they sell very few umbrellas, and let's say they have a 0% return. Okay, they make no money that year. In year two, it's rainy. And so a lot of people are buying umbrellas and they have a very good year, very good rate of return, let's say of 10%. So what was their average return over this 2-year period? Or over this 2-year period, they returned an average of 5% per year. Okay, so you got 5% per year, but you had to put up with some ups and downs. You had to put up with a year where you got 0 and then a year where you got 10. So there were some ups and downs along the way. What instead if you put 100% of your money into a sunscreen company? So the sunscreen company during the sunny year, they do very well for themselves. A lot of people are buying sunscreen. And so it earns a 10% return. Okay, you earn a 10% return. And then in year two, when it's rainy, nobody's going to the beach, nobody buys any sunscreen. So let's say that year you get a 0% return. You don't make any money. So what was your average return if you put all your money into the sunscreen company? What was your average return? Well, your average return was 5% per year. It's 5% per year. But again, you had to put up with ups and downs. You had years where you had 10% returns. You had 0% returns. You had to put up with ups and downs. So the question is, and those ups and downs, by the way, that's what we call risk, putting up with those ups and downs. So the question is there a way to get rid of the ups and downs? Well, watch this. What if we put 50%? What if we put 50% of our money in the umbrella company and put the other 50% of our money in the sunscreen company? Well, then we have a total portfolio that is made up of 50% umbrella stock and 50% sunscreen stock. So on the first half, or on the first year, on the sunny year, half of our portfolio is going to earn 0%, because it's that half is invested in umbrellas. The other half of the portfolio is going to earn 10% because it was invested in sunscreen. And so the total portfolio will have a 5% return. Okay, the total portfolio will have a 5% return. Half the portfolio will return nothing. Half of it will return 10% for an average for the entire portfolio of 5%. Look what happens on year two. Year two is a rainy year. So year two, the umbrella stocks, that half of our portfolio is up 10%. The other half of our portfolio, the sunscreen, that's going to make zero. That makes 0% in the second year. But the average for the total portfolio is 5%. Okay, again, why? Because half the portfolio earned nothing. The other half of the portfolio earned 10%. For the total portfolio, that's a 5% return. Okay, what is our average then for the entire portfolio? Year one, we earned 5%. Year two, we earned 5%. Our average rate of return is 5%. We earned 5% per year. Now, notice the cool thing about the portfolio. We earned the exact same return as we did if we put all of our money in the umbrella company or all of our money into the sunscreen company. Either of those investments would have given us 5% return. Here, we get the exact same 5% return, but we took less risk. There's less up and down in our portfolio. We took less risk. See, so here's the thing. By diversifying our portfolio, that means holding more than one company. By diversifying our portfolio, holding more than one company at a time, we could reduce our risk, but still get the same average return. We still got the same average return. So this is the power of what we call diversification. So here's our solution to specific stock risk. You could buy the entire market through what are called index funds. So for example, you could buy the total stock market index funds. Lots of mutual fund companies sell one of these. A total stock market index fund, which takes your money and puts a little bit of your money in every single publicly traded company, or at least a random sample of all the publicly traded companies in the United States, and you will now be completely and totally diversified. If any one company goes bankrupt, no big deal, because you own all these other companies as well. Okay, so you are completely diversified, and the argument is that in the long run, you'll do just as well in this completely diversified portfolio than if you had taken specific stock risk and put all your money in one company. You see what happened up here? If I put all my money in umbrella company, I get the same return, but with higher risk. If I do it in a portfolio, if I invest in a portfolio, I get the same return, but lower risk, less ups and downs. So this really is an example of, or close to an example of, what economists often call a free lunch. You really can lower your risk without losing any average return. You really can lower your risk without losing any average return through what is called diversification. Okay, so one of the things that a random walk person would do is say, diversify your portfolio. Buy a wide investing index fund, such as the total stock market index fund. All right, this has been Mr. Hagan on another Econ podcast. Thanks for joining me, and we'll see you on the next podcast.